Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, October 13th, just after the close. So post-terrorist attack Saturday, we really saw the kind of action you would almost expect. Market can act in odd ways from time to time, but going back to Russia's invasion of Ukraine and similar conflicts over the last 25 years, we see a bid to Treasuries and a bid to oil, especially when it's an oil producing or an oil related region like Russia was or the Mideast. Does that continue, those bids? We'll see. There had been an awful lot of pressure on Treasuries. Remember, pressure on Treasuries meaning yields up, prices down. We saw that reverse a little bit with that flow into really that safety bid we saw. You know, what we're looking at day to day here is trying to differentiate between where is there reasonable expectations for solid performance going forward. And we go through sectors, we go through industries, we go through indices. And I just wanted to share something that popped out at me. I know I mentioned utilities the other day hitting really severe oversold conditions on that move higher in rates, right? That often happens. Utilities tend to move with rates. When rates are dropping, utilities have a stronger bid than normal. That dividend in utilities can appear attractive. So utilities have sold off. Today I want to share a chart on staples. You hear me mention staples from time to time. I think 3 or 4 weeks ago I said perhaps the reason staples weren't acting defensive in that sell-off of September was that you could park cash at 5% and not have to worry about the volatility of staples. But let's take a look at this chart. I want to bring your attention to the top half of the chart, and then we'll get to the bottom half. I know can be a little noisy, but just stay with me for a moment. I want you to look over at the right-hand side, October 23. We hit a level in the 10-week momentum distribution chart that I often discuss on here of 127% oversold this week. That is a figure we rarely see. As you know, I say we really start to want to pay attention once we crack 100 oversold, or on the other side, if we get more than 100, 110, 127, 120% overbought, maybe we want to take profits. What we're focusing on here is the fact that over the last 20 years or so, we've only hit this level twice. 2 times in the last 20 plus years. When we go back to the July 2002 level, it did take a couple more months for staples to find their feet, to find their legs under them before going on a nice lengthy move higher. In the COVID drawdown, they bounced like everything bounced off that March, and that was the key, right? COVID March, when everything bottomed together and moved higher. The point isn't how quickly staples respond here. It's how much downside is left. Because we know we can't time anything perfectly. But is there a scenario here that we can start to nibble in staples, which we don't own any of? We don't own any utilities. Are they getting to a level that we have to start to nibble just for a bounce? And that's what the plan would be. So if you look at the bottom part of this chart, you see how oversold the individual names are within that basket, that ETF basket XLP. And some of those names are everyday names: Clorox, Hershey, Coke, Pepsi, Archer Daniels. Those are some names that have long histories of solid profitability. And if markets do tick up in volatility, and the Middle East, along with Russia and Ukraine, continue to disintegrate, you would expect staples to get a bid here. So we'll keep an eye on that, and we'll update you on what we're doing there. You know, one thing to keep a quick eye on, look at King Kong Costco. Look in the middle of the chart. really sitting at the medium trading range of the last 10 weeks. That's been one of the great stocks of the last 20 years, Costco. So although it's a staple in that basket, it's shrugging off the weakness. That's relative strength. So again, a name we'll have to examine. So the Moose is with you remotely today. Let's shoot it over to him.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. It is Friday afternoon, October 13th, about 1:30. This week, we saw in bonds drops in yields across the board. Continuing to what we've talked about in the past, investors running to the safety of treasuries when you see strife in the world, like we have in Israel this week. 10-year bond down from a 480 to a 465, down 15 basis points. Got as low as a 452 at one point. 30-year bond down from almost 5%, a 497 at the end of last week. That got down to right now around a 480, down 17 basis points. That got as low as a 467. So at one point down 30 basis points. A lot of volatility. What was some of the backing and filling? Certainly involved the CPI number yesterday, which the headline number came in a little hotter than expected. Core number came in as expected. And really, when you see a little bit hotter, people lose a little bit and bid off the bonds somewhat. But we know that most of that was related to the energy. And energy is probably going to stay elevated for a little while. When you dig into the core numbers, core pretty well behaved, continues to ratchet, in that 0.3 area where the expectation was. I think the important point is that we know the Fed is going to keep high short-term rates for a long period of time. That caused the consternation that we saw last week with longer bond yields going up. This week, geopolitical events ruled the markets. They will probably continue to be a very important point in the markets as we go forward. Volatility will tend to probably get a little less as you go forward because markets tend to live with strife and react to strife, and that will happen with this case too. So we will see how this plays out. Municipal bonds had a great week. They were down about 17 basis points across the board this week. And that was investors really following along with treasuries and say, boy, you know what? We saw high-grade bonds near 5. We're going to buy them. And that's what happened this week. It was a grab-a-thon out there. Again, all related to the strife going on over in Israel. We will see how this transpires. It'll clearly be one of the defining forces in the bond market as we go forward. We'll keep everybody informed, and we'll see you next week. Thanks a lot.
Thanks, John. Great information. Additionally, we have our Q3 quarterly review as well as a special update on the Middle East conflict available on the channel. Check it out. We'll see you next Friday. Enjoy the weekend.